Welcome to the Daily Insights That Matter. Now, the Ministry of Commerce and Industry released India's foreign trade numbers for the month of January, wherein the trade deficit was reported at a one-year low of $17.75 billion. Let's look at how India's foreign trade fared in the month of January. As you can see in the chart, the merchandise exports fell by 6.5% year-on-year to $32.91 billion from $35.23 billion. Merchandise imports also fell by 3.6% year-on-year to $50.66 billion from $52.57 billion. As a result, the trade deficit was reported at $17.75 billion. Now, the highlight of the latest foreign trade report were the services exports, which grew by almost 50% to $32.24 billion from $21.63 billion last year. Now, this led to a trade surplus, specifically in the services trade. Now, India's exports have been affected by the slowdown in major economies due to the Russia-Ukraine crisis, the rising energy and commodity costs, high inflation, and the monetary tightening measures being taken by major economies to control this inflation. Going forward, in the short term, India's exports are expected to remain sluggish on the back of an anticipated global slowdown. However, do know that India does not rely heavily on its exports like other emerging economies. Having said that, bolstering the export industry is essential for maintaining growth, given the market confidence surrounding India's manufacturing growth story. Now, since the beginning of 2022, there has been a surge in oil prices owing to the Russia-Ukraine crisis. Domestic energy producers were making windfall profits by selling crude oil to domestic refineries at high international prices. Now, in July 2022, for the first time, the central government had imposed a windfall tax on domestic crude oil producers in an effort to stop this. But later, they reduced the windfall tax due to the easing of the international oil prices. The central government has once again slashed the windfall profit tax levied on domestically produced crude oil as well as on the export of diesel and aviation turbine fuel, in line with the rising international oil prices. Now, windfall tax on oil companies is a tax imposed on oil companies when their profits exceed a certain threshold due to unexpected and unanticipated circumstances. Windfall tax is levied by the Union Government of India on profits made by crude oil manufacturers for any price that they get above a threshold of $75 per barrel. Now, the centre had first levied the windfall tax on oil companies on 1st July 2022. Now, the windfall tax on oil companies is hiked or slashed frequently due to the volatile nature of the oil market. When the global oil market is in a downturn, governments may reduce the windfall tax to incentivize oil companies to continue operations within the country. Conversely, when the market is booming, government may increase the windfall tax to capture some of the increased profits enjoyed by the oil companies. The levy is reviewed every fortnight and the rates are moderated based on the international oil prices at that point in time. Now, the central government cut the windfall tax on domestically produced crude oil to 4,350 rupees per ton from 5,050 rupees per ton. And it also slashed the tax on the export of diesel to 2.5 rupees per litre from 7.5 rupees per litre, along with a reduction in the excise duty of ATF to 1.5 rupees per litre from 6 rupees per litre. Now, the tax cuts have come in at a time when the refiners have continued to stock up discounted Russian fuel amidst a steady increase in domestic consumption. Now, the crude oil prices have been volatile in the recent months. Brent crude currently is being traded in the international market at a range of $84 to $87 per barrel after touching an all-time high of $140 per barrel in the month of March. If the stability in oil prices continues, this will help in further reducing the windfall taxes going forward. So, what does all of this news mean for you? India's export prospects in the near term are slightly uncertain due to global macroeconomic climate. However, we believe that India's exports would increase as the global obstacles subside and policy actions take shape. This will therefore have an indirect neutral impact on you. Now, the tax cut on domestic crude oil output would mainly affect the margins of domestic oil producers. However, the reduction on levy on exports of fuels will benefit the private refiners. This announcement will therefore have an indirect neutral impact on you for time being. While I say this is Raj Mehta signing off, wishing you and your loved ones the very best. Thank you.
Did you like watching this video? Then download our app, Informed Investor, to watch more such informative and interesting videos.